In the last episode, we met the crypto landscape from above. Bitcoin, the scarce digital gold, and a vast wilderness of coins below it. Today we zoom in on the second giant, Ethereum, and a strange, fascinating, and frankly dangerous new world that gave birth to decentralized finance, or DeFi. This is the deep end of the pool, so hold on and keep your skepticism close. Let's quickly settle the difference between the two giants, because it is the key to everything. Bitcoin's job is simple and singular: to be digital gold, a scarce store of value. That is essentially all it does, and it does it well. Ethereum set out to do something far more ambitious. It wanted to be not just money, but a platform, a global computer that anyone in the world could build things on top of. And the thing that makes Ethereum a computer is the smart contract. A smart contract is just a piece of code, an agreement that executes itself automatically when its conditions are met, with no lawyer, no bank, and no middleman to enforce it. If this happens, then send that automatically and unstoppably. Think of a vending machine. You put in the money, the logic runs itself, and out comes your snack, no cashier required. Ethereum is a world full of programmable vending machines. Running this global computer is not free, of course. Every time you use the Ethereum network, you pay a small fee, charmingly called gas. Gas is what you pay the network to execute your smart contract, and when the network is busy, those gas fees can spike painfully high. It is the cost of using the world computer. Now, what did people build with these self-executing contracts? The biggest and wildest creation is DeFi, decentralized finance. The dream of DeFi is enormous. To rebuild the entire banking system, lending, borrowing, trading, earning interest using nothing but smart contracts with no actual bank anywhere in the middle. Here is how it works in spirit. Instead of depositing your money in a bank that lends it out and keeps most of the profit, in DeFi you put your crypto into a pool of code. Others borrow from that pool, putting up their own crypto as collateral, and they pay interest directly to you, the supplier. The smart contract is the bank now. The middleman has been replaced by software that anyone can inspect and no one fully owns. A crucial piece that makes all this usable is the stablecoin. Remember how violently crypto swings? You cannot run a sane lending market on something that drops 40% in a week. So stablecoins were invented, special coins engineered to always be worth about $1 by being backed by real dollars or assets. They're digital dollars that live inside the crypto world, the comm chips you actually move around the wild casino. And one piece of hard-earned wisdom you must absorb about ownership. In crypto, there is a saying, not your keys, not your coins. Your crypto is truly controlled by a secret private key, a long password that proves ownership. If you hold that key yourself, in your own wallet, you, and only you control the coins. If you leave them on exchange, the exchange holds the key, which is convenient, but you're trusting them completely, and exchanges have collapsed and vanished with everyone's money before. Now the part where I must raise my voice, because DeFi is breathtakingly risky. First, it is only as safe as its code, and code has bugs. Hackers have drained billions of dollars from DeFi projects by finding a single flaw in a smart contract. And once the money is gone through the unstoppable code, it is gone forever. There is no bank to call, no fraud department, no reversal. Second, the frontier is swarming with outright scams. The most infamous is the rug pull, where creators launch an exciting new project, lure in millions of dollars, and then simply vanish with all of it overnight. And third, beware the advertised yields. When a DeFi project promises you a magical, impossibly high return for parking your money, that astronomical yield is almost always a flashing red signal of enormous, hidden risk, not a free lunch. So let's place all of this on the shelf where it belongs. Ethereum and smart contracts are a genuine technological innovation, and DeFi is a fascinating, ambitious experiment in rebuilding finance. But it is also an immature, unregulated, scam-ridden frontier where fortunes vanish in an instant through hacks, rug pulls, and seductive yields that were always too good to be true. It is the most advanced and most dangerous corner of an already dangerous asset class. And so, the calm conclusion we never abandon. None of this, not Ethereum, not DeFi, not stablecoin yield farming, is necessary to build long-term wealth. It is a thrilling frontier to understand and an extraordinarily easy place to lose everything. The patient index investor watches the whole spectacle with curiosity, risks at most a tiny amount they are fully prepared to lose, and keeps the serious money quietly compounding in the boring, proven broad market. So now you have seen the deep end. Bitcoin is digital gold. Ethereum is the world computer. Smart contracts are self-running agreements. And DeFi is the wild, brilliant, perilous attempt to rebuild banking without banks. Explore it with your eyes wide open. I'll see you in the next one. Until then, keep it simple and never confuse a high yield with a safe one.